Today is January 20th, 2015, and I wanted to talk about the Chinese stock market bubble. And I want to get this out while I thought about it, what was on my mind. And it would be, of course, a little bit better if I could do a video. Maybe I'll do that in the future as part of the research. But I want to go ahead and get this out so that you'll be aware of it. Maybe some of you already are. Now, those of you who've been following me for a few years know that on many occasions I have come out and I have talked about this, I've written about it, and that is the eventual blow up of the Chinese equities market. And I mentioned it wouldn't be any time real soon, probably, although any day is possible, but I suspect probably it's going to be around 2018, 2020, something around that period, although that's just a guess. The bottom line is I think it's going to take a few more years as China continues to liberate or liberalize its currency, as it continues to move towards floating the yuan and also opening up access to investors worldwide of its stock markets. And I talked about this on numerous occasions, pointing to the extreme lack of transparency in the Chinese capital markets, in addition to all kinds of fraudulent behaviors going on, accounting problems and so forth, which we really don't know the extent of, right? Now, I think it was about maybe 2 years ago, we got an early taste of some problems. You might recall there was a period where several Chinese firms were completely engulfed with all kinds of fraud. Big problems caused some concerns with regulators. And these publicly traded companies were shell companies, essentially, or not in all cases, but in many of the cases, of course, they were reverse mergers. Now, reverse merger, that's just basically where if you want a publicly traded company, you can spend a couple of $100 and go buy one. And it's like a defunct company that was previously something else, and you can change the name and change the bylaws, change everything, and create your own company, and it can be publicly traded. Now, I'm not going to get into the details of all that because, of course, there's more to it than that. You have to have a market maker and so forth. But the point is that you're not going public, right? There is a process, and it's certainly not perfect. It's filled with all kinds of baloney, right? The underwriting process, when you take a company public, Wall Street, let's say. But the bottom line is this. You have some accountability. There is some type of prudence and due diligence that's done. And in many cases, it's actually quite good. That is with Wall Street. But when you are taking a company public through reverse merger, there's no due diligence. You're not dealing with any type of Wall Street analysts, bankers, or anything like that. And the reason why is because you don't need to, because Wall Street takes companies public through this whole process to ensure that its investors, mainly institutional, are receiving good research, good opportunities to invest in companies in an early stage, that is the IPO or pre-IPO period, right? Anyway, I'm not going to get into more detail with that. The bottom line is this. We saw this issue a couple of years ago, and I know that I commented, probably in a video or something, that this was not the type of blowout that I was talking about. It's maybe like an early warning sign. The blowout that I'm expecting in the Chinese stock market is going to be massive. And it's impossible to know, but I would have to believe it's going to probably not be as severe as what we saw in the dot-com collapse, with all the accounting fraud and all the multiple levels of securities fraud. But I would say it's probably going to be in that same universe, in the same realm. But we'll have to just wait and see. Now, the reason why I'm pointing this out is that, not to get worried or not to obsess over it, but you just put it in the corner, right? Put this information in the corner. You've got it there. And if you're aware of the possibility that I am presenting to you, then you will spot it early on. Give you a much better chance of spotting it early on. Now, a couple months ago, you heard about China opening up its stock market to global investors, foreign investors, right? The bottom line was basically they were allowing foreign investors to participate in the Chinese stock market directly, as opposed to in the past. And we're talking about ADRs. That's the only way you could invest in it, right? Basically, even on the New York Stock Exchange and so forth. ADRs, and actually they're not even really ADRs. There's a kind of a complicated variant of how the Chinese list their securities. I'm not going to get into that. It is somewhat controversial. But the bottom line is that this way they announced finally you can buy the securities directly. Of course, it's not as easy as it sounded, because what it means is that you have to buy them through the Hong Kong exchange. You got to buy it through Hong Kong first, and then through Hong Kong they purchase the securities. So it's not that easy, but still it can be done. Online brokerage firms, at least in the U.S., have not elected thus far to allow their customers to participate in that market. Okay? So as a result of this, and they passed this, I guess it was effective in maybe early to mid-November of 2014, you saw a run-up, and this is the Shanghai mainly, right? Now, if you do a search for ETFs related directly to track the Shanghai and the Shenzhen, the two stock markets in China, you're really not going to find much. There is probably one or two of those. One tracks the Shanghai Shenzhen 300, and there's another one I think that may track the Shanghai, more recent, through Morgan Stanley. CAF is the ticker on that. The fees are quite high, actually. But anyway, the point is that, and it shouldn't be, that's kind of the point. When you've got something that tracks an index, it's somewhat of an index fund, so the fee should be very low because it's fairly passive, right? But I think for this Morgan Stanley fund, CAF, I think the expense ratio is about 1.75%, which is very, very, very high. And I guess, there's really not any competition. They don't have any other funds out there, so, they can charge a high rate. But anyway, the point is this. If you look at the Shanghai composite, you will see a kind of a minor run-up in the days prior to this official announcement. And that was basically people, I don't know to what extent this information was released in China prior to it being announced in the U.S. I would say that it was not, publicly disclosed in China, or otherwise it would make the U.S. And other media outlets throughout the globe immediately, right? I would say that it was insider deal, where people knew about it in China, in Hong Kong, and they propped up the market, got in, because they knew once they opened it up, what's going to happen? The sheep are going to flood in, right? They're going to be herded in, boost the stock market. What's happened? Well, instead of the Shanghai closing out the year with lackluster performance, the Shanghai closed out the year in 2014 beating all markets, all equities markets all major equities markets in the world. And that performance was close to 60%. The thing is that prior to that announcement, the performance was probably, the way things were going in China, I would say was probably going to pretty significantly underperform the S&P. But if you look at a chart of the Shanghai, you'll see a few bumps, a few months prior. You'll see a bump in the summer, and then you'll see one later on and so forth. This is clear to me as insider buying, because they knew this was going to happen. And then once it happened, in November, it soared. The Shanghai soared. And it is now in bubble mode. Okay? It's in bubble mode. Will it go higher? Probably. We don't know. Bubbles can last a long time and they can expand a great deal. I would say that aside from some corrections, you're going to see a continuation of this bubble. And depending upon when the online brokerage firms from the U.S. and other countries decide to get in, they're basically waiting on the sidelines and seeing how things go, right? If there's not a blowout over the next year, I would say you're probably going to see some of the major online brokers start to offer the stocks of Shanghai via Hong Kong to their customers. And then we're going to see a huge bubble. I try and point this stuff out occasionally in the research. For instance, I think maybe a couple of years ago, I talked about the fact that Chile derives a huge percentage of its export dollars from copper sales. It's the main copper producer of the world. And I talked about how the deflationary spiral in commodities was most likely going to push copper way down, and I think copper has still a ways to go down. And that would impact adversely Chile's economy. And that's exactly what's happened. So this situation with China, we could see a potential blowout. And no one really knows when that's going to happen. It could happen, later on in 2015, or it could happen 5 years from now. We don't know. But if you're interested in that situation, it's something to monitor. Because if you're an aggressive investor, aggressive trader, of course, you can short some of these ETFs, and probably there'll be more that roll out in the near future. And you can do that once you see a blowout coming. So I bring this up because based upon what's going on in China's economy, right? I've been talking about the slowdown in China for quite some time now, and I've been talking about the fact that the smart money has been focused on China now for a year or longer, right? Watching to see what's going on, how they're dealing with their slowdown. So depending upon what happens in China, we could see an early version of this blowout of a bubble. But I just wanted to point this out quickly because I know that oftentimes when I come across something, if I don't go ahead and write something or speak about it, and of course it's much better in terms of a time factor, it's much easier, much quicker to just open up the recorder and record something and publish it very quickly without any editing or anything like that. If I don't do that, I'll forget about it. Okay, so rather than take the chance that I'll remember and spend some more time to actually provide a decent video and do some research, I think this is a much better situation because at least you've got something there and you can kind of take it and run with it on your own. But I wanted to alert you early on because it's only been about 2 months, right? It's only been about 2 months. And this stock market, the Shanghai, has soared. And based upon what I have seen in the past with the way these things play out, chances are it's going to go a lot higher. Certainly would not recommend anybody get involved on the buying end. I would kind of just keep my eye on it here and there, keep my eye on what's going on in the Chinese economy, and wait for signs, more definitive signs of a bubble, right? Mass participation. The more sheep that get involved, the more that bubble's going to swell. The big problem, in addition to kind of a bubble formation, is that, keep in mind, when you look at the U.S. equities markets, you're talking about institutional investors primarily determining the prices of securities. When you look at the Shanghai, the vast majority of investors are retail individuals that don't know jack shit about valuation. They don't know anything. And even if they did know, they don't have the transparency. How are they going to look at the financial statements? Are they going to have these things audited appropriately, right? And you don't have the analyst coverage as well. So you're dealing with a huge potential disaster. Okay? So perhaps I will provide some updates on this in the near future, or maybe down the road. We'll just have to see.